Investment mistakes result in a loss of net worth and can even be devastating. However, anyone can be a great investor if the most common mistakes are avoided. While you most certainly can learn about these mistakes the hard way through direct experience, it is far easier on the nerves and the pocketbook to learn from the mistakes that other investors have made. Welcome to the Seth Rain Money Guide, where we help lead you toward your goal to reach financial freedom. Today, we'll be going over 11 common investing mistakes and how to avoid them. Be sure to like this video and subscribe to the channel. Also, hit the notification bell to get notified of new uploads to the channel. There are new videos being released regularly, and we want you there for every one of them. But before we get going, just remember that we are not financial advisors. We are simply sharing our opinions regarding finance with no guarantee of gains or losses on investments. While we hope the information you learn here proves valuable to you and your aspirations for attaining financial security, you should always first consult with a professional financial advisor before making any major financial decisions. With that being said, let's get started. The bad results from your investments are more likely due to the mistakes you're making than from your lack of investing knowledge or expertise. Here are some common mistakes to avoid to maximize your investing returns. Number 11, not understanding your investment. Warren Buffett, one of the most successful investors of all time, says that you should never invest in something that you really don't understand. You should only invest in companies that you both understand and believe have long-term value. Before you invest in any particular stock, be sure that you can clearly write down your reasoning behind your investment choice. Warren Buffett adheres to the following 3 basic principles when selecting a company for investment. First, they must earn good returns on the net tangible capital required in their operation. Second, they must be run by able and honest managers. Finally, they must be available at a sensible price. Number 10, churning investments. Some people confuse speculating with investing. If you're monitoring the financial media 24/7, looking for information to guide your day trading activities, you're not investing. You are speculating. Not only does day trading rarely work over time, it can also be very expensive. If you're constantly buying and selling with small orders, the transaction fees will cut into your profits. The taxes on this kind of trading activity is also detrimental. Every time you take a profit, you're potentially increasing your tax burden. That means less money for future investments. Taking a 100% profit in 10 years is much more lucrative than taking 10% profits and being left with less money to reinvest each time. Number 9, panicking when the market drops. Many investors don't deal with market drops in a calm, cool, and collected manner. You might recall the great stock market crash from 2008 to 2009. In less than 12 months, the Dow lost half of its value. What did many of the investors at that time do? They sold, and they sold at the worst possible time, when the market was at the bottom. What if they had instead seized the opportunity to buy? The Dow Jones Industrial Average hit its low in 2009 at 6,626.94. As of January 21, 2015, the Dow Jones Industrial Average is sitting at over 17,500. The market has increased 165% since that low in 2009. Number 8, not investing with an appropriate level of diversification. Too little diversification provides more opportunity for great gains and losses. Putting all of your money into just a small number of investments is risky. One bad year could nearly wipe out your entire nest egg. Too much diversification can be an issue as well if it isn't done properly. Unless you're wealthy, achieving a very high level of diversity is costly. Those with more modest means can best achieve a high level of portfolio diversity with a mutual fund or index fund. Maintaining a reasonable level of diversification is just as important. It's also important to rebalance your portfolio from time to time. Reinvesting in your current losing stock is psychologically challenging, but it eventually pays rewards. Number 7, buying stocks on margin. It can be tempting to consider borrowing money against your current investments to fund additional stock purchases, but buying stocks you can't really afford in the first place is a recipe for disaster. Eventually, you will have to make a margin call after your investments lose too much of their value. In that case, you very likely won't have the necessary collateral anymore to support your loan. A margin call results in selling stocks and bonds at the worst possible time. When it happens, you're forced to take a loss. Avoid putting yourself in a position that requires you to sell assets when you should be buying assets instead. Number 6. Giving too much credit to professional money managers. You might think that professional money managers would be excellent at their jobs. After all, they're well-educated and extremely well-paid, but studies have shown that very few money managers will beat the market over a long period of time. Why pay 2 or 3% or more for results that lag the major market indices? You're paying extra for lackluster results. Number 5. Mistaking a strong market for financial savvy. When the market is growing strongly, everyone looks like a financial genius. There are even some years when the market grows nearly 30%. You should definitely enjoy your good fortune. However, stay humble. It is during times of euphoria that Warren Buffett says everyone should be getting worried. Stock prices tend to become artificially inflated during times of high expectations. Sooner or later, the other shoe drops. If you're consistently beating the market, you should begin to wonder if you really are a stock-picking genius. Number 4. Relying too much on short-term performance. Many investors chase mutual funds, money managers, or asset classes based on recent performance. However, such pursuits often result in bad decisions. The only truly accurate deduction you can make about a stock, mutual fund, or market sector that has thrived over the last 3 years is that you probably should have invested 3 years ago. Number 3. Failing to invest in stocks. Unless your time horizon is short, stocks have been shown to outperform bonds and other types of investments. Investing in an index fund is a simple and effective way to expose your portfolio to stocks. When the market is running strong, many investors decide to wait for a market correction before investing. However, it's impossible to know when a correction will happen. It's very possible that you could enjoy growth of 50% or more before a correction occurs. Just continue to invest anyway. Number 2. Not having an investment plan. There's an old joke in the investment world that most investors spend more time planning a vacation than picking a stock or planning their investments. Unfortunately, that is true in most cases. Those who have a written financial and investing plan outperform those without one. Be aware of your goals and your time frame. Forcing yourself to consider this issue will help to ensure your success. Number 1. Taking advice from questionable sources. Almost everyone has an opinion about investing and is usually more than happy to share it. Do you know how successful your source has been with his investments over the last 20 years? In most cases, your neighbor or brother-in-law are not going to be helpful with your investing activities. If you're going to take advice from anyone, ensure they were once in your financial position and have attained the goals you are currently pursuing. Taking advice from others is a significant shortcut with regards to time and energy, but be cautious when taking advice. Make sure you always do your own research and consult with a professional financial advisor when you have questions. If you're like most investors, you're probably committing at least a few of these errors. Realizing mistakes is the first step to correcting them. Take note of your top investing mistakes and make a commitment to avoid repeating these errors in the future. Avoid making mistakes, and your wealth will grow substantially. Well, that's all we have for today. Thank you so much for watching. If you enjoyed the information we provided, please hit that like button and subscribe. Be sure to check out some of our other videos for more great ways to make money work for you. See you next time and take care.